Good morning. Today is June the 17th, and this is another episode post FOMC of Two Grey Beards. Hi,
Hey,
Andy.
Nick. How are you?
Good, good. What did you think of the FOMC? That's the big news of the week.
Yeah, lots of central bank action, lots of market action as well, and some data. It was a big week. I look back to what we said last week, which I consider us pretty much in the higher for longer camp. And our estimation of last week was that the Fed was likely to pause, not hike, decent chance of that, and or hike 25, which, was not the odds bet. But in either case, the projection of the terminal rate was going to rise from 5.1 to 5.25, 5.5. And 5.5 to us was a pretty
Yeah.
hawkish move. And they hit 5.6, which means they are projecting not only one hike in July, which I think is almost near certainty, but two hikes before they end. So I thought
Yeah.
that was notable.
I think the market got overexcited after CPI because it was zero point 0.1 lower on the headline number, but the core just keeps on showing you that inflation is sticky. And I think there's very little likelihood that they will hit their core numbers this year, the numbers that they're expecting to hit by December, without more hikes. And therefore, higher for longer is here to stay.
And they actually raised what they expected inflation to be at the end of the year by a meaningful amount, 25, 30 basis points. They also decreased where they thought unemployment would be, which again is a higher for longer outlook. I think their outlook for how inflation and how unemployment goes is now relatively in line with mine and I think ours. And it's still a tough target to get to the unemployment target that they have, or more so the inflation target that they have. Inflation has to fall very rapidly. Core PCE or CPI, core CPI, both have been running pretty consistently for 6 months at
0.4.
0.4 or higher, which is, when you multiply it by 12, 4.8%. And they're projecting below 4 by the end of 3.9, I believe, by the end of this year. In order to do that, with the prints that already have happened, inflation has to run below 0.27 each of the next 7 reports. I don't see how that's going to happen.
Yeah, very unlikely. And that is why they have the dots where they have them. And that is why the market should expect another 2 rate hikes. My view is that they would love to get data in line with what you say around the 2.7. They're not going to get it. And they are basically in a box. They are going to have to raise twice more this year. And the market is not going to like it. It's as simple as that.
Yep. More data for the week. The ECB hiked 25 basis points, which was completely expected, and they guided for very likely 25 basis points in July. This, as we mentioned in the prior episode, after the Bank of Canada and the Bank of Australia hiked 25 in what was a surprise to those markets. And the BOJ didn't change their policy stance, which is consistent with, I think, our global outlook that Asia, China, Japan, and the whole of Asia is slowing and needs fiscal stimulus potentially, which we're likely to get from China over the weekend, and continued monetary easiness. And so the BOJ didn't surprise me, but they were easy. And so that's what happened last week. What do you think happens next week?
I think happens next week is that we've already had it this week, i.e., that the markets rallied, the equity markets rallied, anticipating the Chinese easing or stimulus over this weekend. and therefore got to those levels. Q hit my target of
That was a
around
great call.
365. All the markets did better, even though they shouldn't have done, front running the possibility of a Chinese stimulus. Very little data next week. We've got Powell testifying on the Hill, which tends to be a snooze fest. But we do have services PMI on Friday, which could be interesting. Those could be turning up again, which again is another higher for longer signal. I think very little upside left in bonds, very little upside, I think, left in equities, but that's just my bias. What do you think?
I was wondering about so I generally like the snooze fest, that is the Hill, and we'll see what he says, but I'm sure he'll reiterate data dependent higher for longer
Hmm.
bias, but we'll see. The calendar's light on auctions. We had quite a bit
20
last
years,
week.
that's all.
We'll just see more bills, and the direction of the RP and the TGA and bank reserves. Those things are doing what we've said they're going to do, which is liquidity through the issuance of bills will come out of both the bank deposits and the RP, but that may not have much impact at all. The following week, we see another set of short-term auctions. We'll address that next week. So the issuance continues to come, and its impact continues to be fairly muted. Your market view, to me, rests on, and my market view rests on the idea that long-term bonds remain in short supply. Government's not issuing many, it's mostly issuing bills, and in fair demand. And that is generating relatively low long-term yields, very high inversion because the Fed is going to hike. And so that's been supportive of equities. And then we have the whole AI story. And as I think about the markets are acting like you would expect in a higher for longer scenario. The front end is yields are rising. The back end is confident that the Fed will kill inflation. And the equity markets are seeing the benefit of high nominal GDP through earnings. And that's the way I'd evaluate what happened last week and think about going forward this week. What do you think about our current macro outlook?
Yeah, as you say, higher for longer is it's no longer a theory. I think it's almost a certainty. And what does that do? That continues the flattening of the yield curve, i.e., more inversion, and it's worse for bonds than it is for equities. So, 2-year notes are on sale, 30-year bonds are doing nothing, just moving up and down in a very tight range, and equities are being bought up on because they are the least affected by the higher for longer, and also that they always have these hopes of AI doing something amazing. No one knows whether we're at the beginning of that bubble or at the end of it. People, when they don't know, they keep on buying equities because that's probably the least risky trade.
And I really think there's two things when I think about equity markets at these levels. Clearly, what has happened is that the PE has gone up. Now, why does the PE go up? There's two reasons. One, the earnings expectations that people are using are not are going to come in hotter, meaning they're using an E that really needs to be adjusted upward. And thus the PE, the valuation, just doesn't properly reflect what earnings will actually deliver. Now, that's a possibility. Now, that has already pushed things higher. And then the other is valuation, which depends on interest rates. And as long-term bonds remain below 4% in yield, PEs are going to be supported. So to what breaks this, and we don't know when, but what breaks this is either E starts going down, AI turns to be overhyped relative to its potential. It has tremendous potential, but overhyped relative to its potential. Or the multiple starts coming down because interest rates start rising above 4%. So to me, we're in a point of uncertainty regarding the outlook. And so that's how I frame the macro environment. What do you think we should
Absolutely.
do about our portfolio?
I think you hit the nail on the head. We are at an inflection point. Either the bond market is going to go through 4% at the long end and crush everything, or this kind of levitation is going to continue and probably go far further than anybody thinks is possible at the moment. So, what we have to try and think about is some kind of strategy which profits us in either case. We have to try and come up with an idea which basically insulates us from any possibility that the equity market really has a bad time over the next 3 months, but also gives us upside.
Right. And what's amazing to me, so I think our synthesis of what's going on here is entirely in sync. So what's amazing to me is how low option prices are.
And they're low for a very good reason, though, because the market has been not pulling back in the slightest and basically going up steady. And therefore, realized vol has not been high, and therefore, implied vol has come down. But it's come down to levels which I think are unsustainable simply because we are at some sort of inflection point. Either now we accelerate higher or we come right back down. So I think realized vol will go up, and therefore implied vol, I think, is getting to the cheap side of
Right.
things.
And so to me, the easiest expression of that, assuming we had no portfolio at all, just reflecting our high degree of uncertainty regarding which way the markets go, the equity markets go, and an expectation that they could go a long way either way. The best way to reflect that would be to buy a straddle, which is buy an at the money call and buy an at the money put. And those things for the next Fed meeting and through the release of earnings for the second quarter, say the August expiry, look to be worth about 2% of the notional on the equity market. So that's very low. 2% to bet means that your break even is, to be right, means the market has to either rally 2% in the next 60 days or fall 2%, and you are better off. So that's what I'd do if I had no portfolio, but we have a portfolio. So what would you do?
There is the easiest thing to do with our portfolio, because our portfolio size is very low, 260 odd thousand in AUM, and at the moment we have something like $57,000 worth of equities, i.e. around 21%. The easiest thing to do is just dump the whole portfolio of equities and buy twice that nominal amount of 57,000, i.e. around 115,000 worth of options on it.
So
that
you mean
is the easiest thing to do.
calls, right? Because we would have.
Correct.
So there are two ways to take a look at our portfolio. You could hold your existing equities and buy puts, which gives you all the upside for 2% cost on the downside. And that could be a trade if you think the market really has topped here. If you don't have any certainty, you could also add calls and have this straddle that I just described and your 20% equity holdings. And that would be, you'd be hedged to the downside. The worst thing that could happen is the market falls, your puts work out to hedge your long, and you give a little bit away on the calls. But if you are right and the market rallies, you are levered long. So that's one possibility. The other possibility is you sell all your equities, and this is called a stock replacement trade. And you'll hear a lot of, and smart people tell you that at tops of markets or at periods of large uncertainty with low volatility, the best trade to do is replace your long stocks, sell them, with calls. You have less downside and you have all the upside. And I think that's what we're really saying.
And actually, if we dumped all our equities, all our ETFs, we could buy twice as many nominal calls and be twice as long as we are now for a very cheap price because volatility is so low. And that is something that we should definitely do at this level.
I think that's one of our more useful ideas for our clients. Obviously, their own tax situations are important, and selling your equities with which turns out to be a fairly substantial short-term capital gain may not be appealing to you. If so, buy $57,000 worth of puts and buy $57,000 worth of calls, and you'll be in the same position as if you sold all your stocks and bought $114,000 worth of calls.
And
so
with
that's what
no
we're at.
tax implications.
Yep. And you have to manage your own. So totally supportive of that. Let's talk about other assets. I still don't love bonds.
No.
I still love cash.
Yeah. Anyone who is buying short-term, low-duration bonds, to me, needs their head examined. 2s, 3s, 4s just makes no sense because the Fed has just told you they're going to hike again, and the 2024 plots indicate that they're going to ease less in 2024. Therefore, we have the ideal instrument in the FRN, in the floating rate note, which pays you 20 basis points over, 1 month bills, and you just keep on rolling, keep on rolling, keep on rolling. That is going to give you far more upside than owning 2-year notes or 3-year notes or 4-year notes. That makes no sense at all. So I think we've got our cash position right. I think we've got our bond position right. We have something yielding us 7% as opposed to 4% if we bought TLT. So I'm very comfortable with all the other positions we have.
The China stimulus is walking hand in glove with the OPEC cuts, which are both symptoms of low demand in Asia. The stimulus needed to enhance demand, the supply cuts because demand is falling. It doesn't pick, unless the stimulus is extremely large and effective, it doesn't paint a rosy picture for commodities, but they also are very cheap. What do you think about them at this stage?
Yeah, still not a trade that I have a strong opinion about. Commodities. I don't particularly like gold at these levels. I've been playing it short, but I'm not getting huge amount of satisfaction. It's more a range trade than anything else. But commodities, I really don't have a strong opinion here. Do you?
Yeah. At Damp Spring, I run a beta portfolio, and that beta portfolio is composed of cash, bonds, tips, gold, stocks, and commodities. And on Thursday, I reduced the 70. It's a little different than the two graybeards. Conceptually, it's the same, but I reduced the assets I own from 70% to 50%, added 20% cash, which reflects maybe stocks go up, but that's only a quarter of my portfolio. And the case for the rest of the assets is poor. And principally because the Fed is going to need to tighten financial conditions. And so, yeah, I agree. I don't think it's time to deploy cash given the current rates that we're getting. And it seems to me sensible to essentially take money off the table on equities while cheaply maintaining and, in fact, levering upside. That just makes too much sense to not do.
And that's exactly what we'll do. And it'll be in my next segment where we put in the orders for next week.
Fantastic. See you next week.
See you next week, Andy. So what happened to our portfolio last week and what are we going to do? We're going to do a lot this week, and we sold 30 shares of the DIA. As you can see, we now have 36 left. I've updated the chart pack for you. The broker statements are all in there. And now let's go on to the order entry, which is interesting. What we're doing this week is we are selling all our equity ETFs. And what we are doing is we are buying 2 shares of the August 18th 440 calls in SPY. Let me try to break down the maths for you. At the moment, as you can see, we are long $57,000 worth of equities. Once we've sold them through this order entry, we will be at zero. But we will have $88,000 worth of nominal SPY, so we are nearly doubling our exposure. If the market falls a bit, we will probably add a third call, a third one lot of calls. So we are going to be in a very comfortable position of being able to buy equities if they fall more than 2%, because all we are paying away to be long of twice as many equities as we are at the moment at 440 is 11.15 or something like that, which will be, we will all do this on the open on Tuesday. So volatility is so cheap that it makes absolute sense to lever in this way. And as we mentioned during the episode, you can do exactly the same by not selling any ETFs, but just by buying one put and one call of the same strike. That's called a straddle. And Andy will also do an explainer, a more in-depth explainer with charts on that, and it'll be posted together with this episode. But these are our orders for Monday, or rather Tuesday, because Monday is a holiday. Have a wonderful holiday, and we will speak to you next week.